Hello and welcome to the weekly market metrics. I'm your host Sandeep Rao and we are in week 34 of 2026. Good to be back in the studio and it seems I have caught a cold but the show goes on. So the big stories for this week. As always, I've been tracking the Hormuz situation. The strait is still in a standoff. Washington says it's open, Tehran says it's shut to anyone who doesn't ask first, but most ships are slipping through with transponders off. Oil prices are still high, with Brent near $93 a barrel. And closer home, the CAS, the newly introduced closing auction session, the one we spoke about in the last episode, well, it seems someone tried to game it. This week, SEBI pulled up two firms for allegedly rigging the Sensex close on the expiry day. One entity flooded the auction with buy orders to push the index up. The other entity took the sell side and both cancelled once they had the price they wanted. The alleged spoils, well, around 3.68 crores. Nothing much. SEBI also released two interesting studies this week on the behavior and the profitability of individual F&O traders. They are worth a read and I'll leave the links in the show notes. And after a long time, the gold rush is back and we'll get into the details when we talk about it in Commodities. But what a week for gold actually. And speaking of the gold rush, there's a bit of sugar rush too in the market. More on that when we talk about sectors. But as for the broader market, it was quite a tepid week with the index closing in the red at around 24,250. With that, let's get into what happened last week and what could happen in the coming week. Starting with the rate of change across the headline indexes, it was a relatively quiet fortnight for the markets. Nifty 50 slipped 0.5% while Next 50 also ended lower by 0.7%. The broader market, however, continued to hold up better with both small cap 250 and micro cap 250 gaining 0.7% while mid cap 150 was largely flat. Now looking beyond the last 2 weeks, the broader market continues to outperform. If you look at the markets over 1 month, 3 month and 6 month periods, microcap 250 remains the strongest performer across all three time frames. Nifty 50 on the other hand is still negative over the last 6 months and continues to lag behind the broader market. Looking at the broader indexes we track in the weekly market metric sheet, Nifty Bank was the only index to end the week in the green, gaining 0.5%, while Nifty 50, Mid-Select and Sensex all closed lower. If you look at the big picture, Nifty Mid-Select continues to lead with a 8% gain so far for the year. Nifty Bank is down a relatively modest 3%, while Nifty 50 has fallen 7% and Sensex remains the weakest performer, down 9% so far for the year. In terms of distance from their all-time highs, Mid-Select is the closest, trading at just 1.34% below its peak. Nifty Bank is about 6% below its all-time high. Nifty 50 around 8%, while Sensex remains the farthest away at nearly 10% below its peak. Looking at the year-to-date performance, the trend remains the same. Microcap 250 continues to lead with gains of over 16%, followed by small cap 250 at around 10%. Nifty Junior has also held up well this year with gains of around 6%, while mid-cap 150 is up about 5%. Nifty 50, however, continues to be the clear laggard and remains down 7% for the year. If you look at the weekly chart, Nifty extended its decline for the second consecutive week. After falling 0.83% last week, it slipped another 0.47% this week. The index continues to face resistance around the 24,600 zone, which has capped every attempt to move higher over the past few weeks. It remains the key resistance. A strong close above it would be a positive sign for the overall markets. If we look at the weekly moving averages, Nifty continues to trade above the 10-week SMA and the 20-week SMA, but it's still below the 40-week SMA. We just spoke about the level 24,600 being the key resistance on the weekly chart, and the 40-week SMA is also sitting right around the same level, making the 24,570 to 24,600 zone an even more important hurdle for Nifty to cross. Now let's look at Nifty on the daily time frame. On the daily chart, Nifty had a weak start for the week, forming 3 consecutive red candles and slipping to the 24,000 zone. However, the index found support around that level and recovered over the last two sessions with two green candles ending the week around 24,250. For now, 24,000 continues to act as an important support, while the 24,600 to 24,700 zone remains the key resistance on the upside. Looking at the daily moving averages, on Monday, Nifty slipped below the 21-day EMA. And by Tuesday, it had briefly fallen below both the 50-day and 100-day EMAs as well. However, Thursday's gap-up opening and Friday's close helped the index recover most of the lost ground. Nifty is now back above the 50-day and the 100-day EMAs and is once again trading very close to the 21-day EMA. The 200-day SMA currently plays around 24,700, continues to be the next major resistance to watch out for. An update on the 1500-point range we've been tracking over the past few weeks. The range continues to remain intact. While Nifty briefly moved above the upper end of the range earlier this month, but the breakout couldn't sustain. Over the last 2 weeks, the index has slipped back inside the range and is now trading comfortably within it again. 24,600 once again is the key resistance. A move above this level would also mean a breakout from the 1500-point range that the index has been stuck since April 2026. Now let's zoom back in and move to Nifty on the hourly time frame. Looking at the hourly chart, Nifty stayed below the 50-hour EMA from 11th August till Friday. Friday's up move took the index back above the 50-hour EMA, flipping the short-term trend back to bullish and capturing around a 200-point move. For now, Nifty is once again trading right around this moving average. Talking about the Nifty weekly expiry, which happened on Tuesday, August 18, Nifty traded in a narrow 105-point range. The at-the-money straddle opened at 88 points and was still trading at 44 points at 3:15 before the market went into CAS. The final closing price was just 11 points below the 3:15 p.m. price. On Sensex expiry on Thursday, August 20th, the index traded in a range of less than 250 points, while the at-the-money straddle opened at 266 points. Interestingly, the realized volatility was lower than the implied volatility. Even at 3:15 p.m., the straddle was still trading at around 138 points, almost 50% of its opening premium. CAS closing was 52 points above the 3:15 p.m. price. You see, since the introduction of CAS, expiry day moves in both Nifty and Sensex have been relatively muted. And yet, 50% of the 0DT straddle premium continues to remain intact up until the last 15 minutes of expiry. Whether this is a bug or a feature, I'm not really sure. Only time and more expiries will tell. Moving on to what to expect in the coming week, looking ahead, the picture remains fairly straightforward. On the weekly chart, 24,600 continues to be the key resistance. It also coincides with the 40-week moving average, making this zone even more important. A close above it would be a positive sign and could finally help Nifty break out of the 1500-point range it has been stuck in since April 2026. On the downside, 24,000 remains the immediate support. As long as Nifty stays above this level, the short-term structure remains intact. A break below 24,000 could once again shift the momentum in the favor of bears. Looking at the straddle premium to gauge the expected range for the upcoming monthly expiry on Tuesday, August 25, at-the-money straddle is trading at around 160 points, implying an expected move of roughly plus or minus 160 points from the current level of 24,250. Now, this is the lowest premium we've seen on 2DT. It'll be interesting to see whether the 0DT premium once again holds on to nearly 50% of its value going into CAS, or it starts behaving more normally. Moving on to India VIX, the VIX continued to cool off over the last 2 weeks and is now trading at around 11.2, pretty close to its lowest levels in the recent months. What this suggests is that the options market is expecting relatively low volatility in the near term. And unless we see a major global or domestic trigger, volatility is likely to remain subdued. That said, with VIX at these levels, any unexpected event can still lead to a sharp spike in volatility. Moving on to the sectoral performance, Nifty Metal and Nifty Realty were the top performing sectors this week, both gaining around 1.8%. They were followed by Nifty Media, while Nifty Bank and Nifty CPSE also managed to make it to the top 5 with a modest 0.5% gains. Over the last 2 weeks, the leadership has been quite mixed. Nifty Media and Nifty Realty featured in the top performers in both weeks, while Nifty Bank also made a comeback into the top 5 this week. As you can see, there was no clear sectoral theme suggesting that the market continues to remain stock-specific rather than broad-based. Now moving on to the TJI sector baskets, as I had said earlier, this week sugar tops the list with a whopping 14% change. Tight supply, festive demand and cane going to ethanol seems to be driving the sugar prices up. Next, we have metal pipes, which are up 5.6%, lifted by the broader metals rally. Then we have transformers up 4.1%, powered by the grid expansion capex boom. Then we have the pipe manufacturers again up 4.1%, drifting up with the broader pipe pack. Lastly, QSR at 3% due to the earnings bounce as food cost inflation eases. It's worth noting that QSR had topped the list the week before last as well. Let's now look at the sectors at their 52-week high. Some overlaps again, but generally what I see stand out in this list is pharma and logistics. As always, double click on these sectors and do have a look. There could be great picks hiding in plain sight. That's all in sectors this week. Moving on to commodities, well, gold's up about 5% for the week, and the reason is what they call soft American data, that is weak jobs and cooler inflation, and that seems to have convinced the markets that the US Federal Reserve won't be hiking rates anytime soon, which in turn seems to have dragged the dollar to a new 2-month low, and gold tends to do well when the dollar goes down. Add to that a bit of safe haven demand from the Middle East and the central banks buying, the rally does seem to have legs. If we look at the gold M and silver M on the charts, gold continued the momentum it picked up after moving above its 50-day EMA on 7th of August. It is now trading around 1,59,950, well above the 50-day EMA at 1,50,040. Silver also extended its rally, closing near 2,48,200, comfortably above its 50-day EMA at 2,36,800. Both precious metals remain in a strong uptrend, and it will be interesting to see if this momentum continues over the coming weeks. Looking at the broader commodities basket, it was a strong week across the board. Crude oil was the top performer, gaining 6.9%, followed by silver and gold, both up around 4.4%. Copper and natural gas also ended the week in a positive territory. On a YTD basis, natural gas remains the best performing commodity, up over 118%, followed by crude oil at 84%. Among the metals, gold has now turned up 7.1% for the year, while silver and copper are still marginally negative. So in summary, not much has changed in terms of the big picture. 24,000 continues to act as a support, while 24,600 to 24,700 remains the key resistance zone. Until one of these levels breaks, Nifty is likely to stay within the same 1,500 point range we've been tracking since April. Volatility remains low, but the behavior of 0DT option premiums, especially after the introduction of CAS, is still worth watching. Outside of equities, gold stole the show this week with another strong rally, while crude oil also remained firm. Overall, next week should once again be all about whether Nifty can finally break and close above the 24,600 levels. Moving on to what caught my attention this week, well, this time two very different topics. The first is an episode of the Odd Lots podcast on the Japanese yen. You see, when a currency falls too fast, its central bank usually props it up, much like our own RBI does with the rupee. What's unusual here is that the United States pitched in to help Japan defend the yen, something I have not seen often. Brad Setzer of the Council on Foreign Relations reckons it can hold, but only if Japan's central bank finally raises interest rates. The aim is to keep the yen from sliding past about 160 to the dollar. The second recommendation is again a podcast from a show called How to Touch Grass by The Atlantic, which asks a very important question. And that's, why bother learning anything when machines can code, calculate, and translate stuff for us? Cognitive psychologist Michelle Miller argues that learning is how we build the mind we want to live in. The effort is the point, and the struggle is what makes it human. I think there's another point to it. We also need to learn to know the subject matter so that we can recognize when the machines go rogue. Both these podcasts are absolutely worth your time based on your interests, and the links are in the show notes. Now over to the events to factor in for the coming week. Tuesday, August 25 marks the monthly expiry for all NSE index derivatives, including Nifty, Bank Nifty and Midcap Nifty. Thursday, 27th, will be the monthly expiry for BSE indexes, including Sensex. There aren't any major domestic events scheduled this week, so it should be a relatively quiet one on that front. If you find the series useful, don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.